Hello and welcome. Thank you for attending this session on liability-driven investments. In this session, we'll discuss what liability-driven investments are and what they can be used to manage different types of risk. I'm Chloe Lau, and I'm a managing director within the Client Portfolio Management Group, specializing in liability-driven investment and other multi-asset solutions. Here with me is Nick CPO Del Campo, one of our head portfolio manager with the quantitative management team here at Manulife. Nick is responsible for the portfolio management responsibilities of liability-driven investments and retirement income mandates in the United States and in Asia. And he has extensive experience working with quantitative research, solution design, and financial engineering in developing and implementing liability-driven investments, as well as retirement income products. Welcome, Nick.
Thanks, Chloe.
I just want to add that we will be taking Q&A questions throughout the sessions, and we'll do a Q&A sessions towards the end of the session. So please feel free to enter your question through the chat, and we'll post the questions at the end of our sessions, and we'll answer anything that you might have. Before getting started, we have several quick polling questions for the audience, which you should be able to see on screen right now. Can we please cue the polling questions? Okay. Our first polling question is on interest rate. Where do you see long-term interest rate 5 years from now? Lower, about the same level as current, or higher than current level? Okay, looks like majority of the audience believe that it would be lower or around the same. Oh wow, our answer keeps changing. That's pretty interesting. It's actually quite even on all three answers. All right. Okay, let's move on to the next questions. The second question, if interest rates do not move significantly in the next 5 years, where do you expect your allocation to fixed income securities to be relative to today? Lower than current, about the same, or actually higher? Give it a few seconds. Also pretty even, but it looks like majority of the audience believe that it will be about the same as the current allocation. Okay, thank you. And let's move on to our last polling question. Have you heard of liability-driven investments, or LDI? And if you have, is it a strategy that you would be interested in? So there are quite a few choices. Yes, I've heard of LDI before, and it's a strategy I'm interested in. Or you've heard of LDI, and you'd like to know more because you might be interested. Or yes, you have, but it's not something you're interested in, or no, you've never heard of it before. Okay. It's very interesting. So I see that majority of the audience actually has not have heard of it. Nick, any insights?
Yeah, so I mean, let's just start with the first two questions. I was actually expecting maybe the first question about interest rates to say that people are expecting to be higher in the future, because something that we've been hearing from our clients for years and years. And now it seems like there's a shift, with I think more people saying lower or maybe the same. So I think LDI is, appropriate kind of it should be a crash course in LDI today to tell you a bit more. And, again, if you'd heard about LDI, again, I'm not surprised with seeing about 60% of you have never heard of LDI. I had never heard of LDI 15 years ago. And in Canada, it wasn't very common, in the United States as well. But right now, it is something that is very common. And from my several meetings I've had in Asia over the past few years, again, it's something new. It's picking up speed. We have more interest, and I think it's very useful to know more about it. And hopefully today it will be helpful for you.
Well, with the answer to that question in mind, I guess we should start by learning what LDI actually is. So Nick, the emphasis on properly managing risk has been receiving more and more focus in the recent years. And we've heard of this term liability-driven investments, or LDI, as a risk management or investment strategy for a long time now. So what actually is LDI, and how does it help with securing future cash flow needs?
It's a good question, Chloe. So LDI is really a different framework about investing. So in a traditional investment framework, you have your assets and you make decisions about how you allocate those assets to typically maximize return for a given amount of risk. And often your risk-free is cash or money markets. In an LDI framework, it's really different. LDI, you split the assets in two. You see either they're hedging assets or growth assets. What I mean by hedging assets is assets that can hedge cash flow needs, for example, of a pension fund. So you could use fixed income securities typically in that hedging assets to cover. So if you have cash flow needs for the next 30 years, you could buy bonds that have similar cash flow profile as those liabilities. And that gives a certain security for that income, especially if you invest in highly rated bonds, such as government bonds. And the other bucket is growth. And growth allows for extra returns. The objective of growth assets is to have a return higher than the hedging assets. And depending on which client, you can have very different mixes. So a client, you can be an LDI framework, doesn't mean you have to be all in fixed income. It's just a portion. It's just how you build your fixed income and how you see your risk. You don't only look at your risk of your assets. You look at your risk of your assets relative to those liabilities or cash flows.
Okay, thank you, Nick. That was a very good overview. And you mentioned about cash flows and liability. So in terms of using LDI to manage, general risk, liability, cash flow, or even retirement needs, what types of different goals would LDI strategy be suitable for?
So, Chloe, there's really a wide range of applications of LDI. Our current clients, we can have pension funds, endowment funds, as well as individual retirement who are looking to secure income in retirement. So, one example we have many clients is a corporate pension plan. Corporate pension plans, typically a company doesn't want to chip in more money into those plans. So they wouldn't want to, their objective is how do we create an investment strategy in order to minimize the additional future contributions. Because that's the last thing you want to do, is to have to pitch in a lot of money into this pension plan instead of doing a project for your own company. So their goal would be to, make sure that their assets don't move so differently than their liabilities. So that would be one of the goals for how you can implement LDI for a pension fund. Another example would be, you've arrived at retirement, you have a sum of money for retirement, and you want to secure, for your basic needs, maybe rent, healthcare, for the next 20 until for your next 20, 30 years of retirement. But you might not want to have annuities. So LDI, you can apply LDI to that and structure a portfolio that will secure maybe a basic income with fairly high probability. And so those are kind of two examples of goals where you can apply LDI.
Okay. Thank you, Nick. And now knowing that LDI strategies can address quite a few different types of goals that, like you mentioned, maybe you can tell us a little bit more about the different types of LDI solutions that are out there in the market that could help us achieve those goals.
Yeah, Chloe. So I'd say that the main couple of ones are custom bond portfolios. So an LDI strategy, I'd mentioned that you can have public bonds, so government and corporate bonds that are used to hedge those cash flows. So if you have cash flows over 30 years, you could buy bonds over those 30 years to cover those cash flows. And those are custom, so each client would be different. As interest rates, people feel are quite low and they're looking for higher returns. We call it LDI plus. So we include extra assets such as real estate, infrastructure, farmland, all these asset classes that have similar cash flow structures over typically on a long time frame that will give up some liquidity, but typically additional expected return out of it. So that's also something we have quite common. And, we have de-risking. So that's a theme. So the shift to more fixed income. So people don't necessarily want to do it in one shot. So if you're allocated 40% into hedging or fixed income securities, and you want to be at 70%, they might want to do that gradually over the next 2, 3 years. And so we have LDI strategies that guide them through that. And I guess the last one that's more recent is applying LDI to individuals for retirement, for decumulation. And that's something that has picked up a lot of interest, especially in the United States over the last couple of years.
Okay. Well, thank you for that. Actually, it's pretty interesting because you mentioned retirement income strategies and decumulation funds in general, and they're part of these LDI solutions that are out there in the U.S. now in the market. Maybe you can tell us a little bit more about them and how they could help with addressing retirement needs.
Sure. Maybe we can pull up a slide number 1 to kind of have a visual. Thanks. So most investment strategy, I would say, in the last 30, 40 years have been really focused on the accumulation phase. Your retirement age is 65. How do we get the most money at 65 so we have an amazing retirement? But not so many have thought of, like, you've gotten to that point and now you're 65 or 70 and you want to retire. Well, how much can I spend? How do I invest that money? Because the big difference now is in the accumulation phase, you're not pulling out money. So if there's a dip in the market, you can recover, you contribute. Now you're pulling out money. So let's say you had to pull out money right, during the COVID crisis at the height of it in, March of this year. Well, all the upside that had in the last, 8 months or so, in the equity markets, well, you won't have gotten that because you pulled out that money because you needed it. So decumulation is definitely a kind of a different. And if you turn to the next slide, we'll talk about how we applied LDI to that. So the idea of LDI is, again, you have cash flows. So if you're in a retirement, you likely have a certain predictable income in the future. You might have your rent, healthcare benefits might fluctuate a bit more, but you might have a good sense of what you need. But you might not want to buy annuities with that money because then you might have unexpected cash flows, or you want to keep that. So the idea here is to structure a portfolio of fixed income to cover a certain amount of those cash flow needs you have in retirement, your income you need, and you keep some in growth. So in this slide, you can see the gray is the allocation into growth or equities, and that shifts over time, and it looks like it's a gradual shift, that it's predefined. And this is not the fact, actually. It is dynamic. So it will shift faster as equity markets would rally and slow down in different times. So this is not predetermined, hence the word dynamic. So we really we both apply the LDI custom bond portfolio. We also apply the glide path, what I spoke. So really 2 parts into the solution to allow retirees to have some security for their income without having to necessarily buy annuities.
Well, thank you, Nick. That was very, very helpful. But I guess that actually leads to my next question, which is related to one of our polling question. In the current market, we've been in a pretty consistently low rate environment. So does having an LDI strategy make sense in this environment, in your opinion?
Well, we're of the opinion of, long-term interest rates are the hardest thing to predict. So you might think it's low now, but it might be negative tomorrow. As we've seen over the last 20 years, we've been told that things have been low interest rates and they keep getting lower. So, I think it's important to kind of adopt LDI just as a framework because it's better risk management practice to kind of align your assets to your objectives and not just purely focused on returns, because you might be taking a lot of unnecessary risks out there. So even though there's low interest rates, we believe it's a it's an important part of good risk management practice for investments.
Right. Thank you. And one of our last question now, and just to remind the audience that if you have any questions, please feel free to put it in the chat, and we'll be answering your Q&A questions following this last question. So just to wrap this up, Nick, what are some of the latest trends you see in LDI and that you see in the market currently and maybe in the near horizon?
So I'd say there's three main trends we have seen. The number one is de-risking. So when I say de-risking, is really a shift of the allocation of hedging, so fixed income typically, that percentage increasing. People are, I guess, have been over the last several years have kept on waiting for interest rates to go up, and they've kind of given up on it, and they don't want all this volatility with growth assets. And the potential that they have to contribute even more because maybe risk assets will sell off. So really, that's the trend. People do it faster than others, but pretty across the board, that's the theme, especially in pension plans.
Okay.
I'd say the second trend we're seeing is including other asset classes. I mentioned before that, using real estate or timberland or farmland, infrastructure, private debt. They're all very, similar to bonds, but they add some extra yield that allows. And I guess the last one would be leverage. Every market is different, and some markets are easier to do than others. So a lot of our clients, they want to have more exposure to fixed income, but typically that exposure might be taken with derivatives. So that allows to keep money in growth. So you can keep equities, but you just might have more exposure into interest rates, sensitivities.
Okay. Those are very, very good points. Thank you, Nick. So we're ready to move on to Q&A now. And just a reminder, feel free to type in your question in the chat, and we'll gather all the questions right now and go through them with Nick. So we have several questions here. The first one is, how do you think that we can best introduce LDI products to our clients who might be everyday regular investors and are not overly sophisticated?
That's a very good question, and sometimes the LDI people get scared. It sounds like a fancy thing, but ultimately what it is to tell a client, an individual, is that you ask what their goals are. Is it to pay a college education for their children in 10 years' time? Is it for their retirement? Understanding and explaining to them that LDI is just really trying to align those investments to those and to have a better chance of meeting them with a higher probability. And, instead of having to cross your fingers and hopefully you'll make it, it's kind of just getting better, lining up better to their needs. And I think that's the main thing. I mean, it comes in different flavors, but that's really an important part I would kind of hammer home with them.
Yeah, that's actually really interesting because essentially LDI solutions can be used, as long as you have a clear objective in mind in terms of a goal that you try to get to. It sounds like it's something that could be suitable for a variety of different client types or different investment or goals and appetite as well. So, okay, so we have a next question here. How does LDI differ from a target date strategy with monthly payout feature?
So it's a very good question, and I was talking about the decumulation. So typically, a payout ratio will pay out a percentage of the NAV of the fund. So if your fund is $100 and you're saying I'm targeting 5%, but your NAV goes down to 80, well, you're getting 5% of $80, right? The idea behind, like say, our strategy with LDI is instead of targeting 5%, if you start with $100, we're going to lock in those $5 every year. And even if your NAV goes down, even if you're marked to market, those $5 have been secured with income from bonds. So those $5, even if you might go down to $80, those $5 have been secured. I mean, as long as there's no defaults in your bond portfolio, you have that security. So I'd say that's the big distinguishing factor of that. And also, and because the fixed income portion is structured for those cash flows, that's why you have the $5. Typically, you have payout ratios. The fund itself is just pulling out a certain percentage of the target percentage, but there's, it fluctuates over time.
Okay, thank you. And our next question, it's I think you can very well answer that just because you visited many Asian countries to introduce LDI to a lot of the clients. Is which market in Asia do you think can benefit the most from your LDI expertise?
It's very
Which
good.
market? Yeah.
So I think it depends on the type of client base. For example, Indonesia has been one that we've had a lot of traction with institutional pension funds. We know that markets such as the ones that are, I guess you call aging Asia, or the populations are older and have and less reliance on defined benefit and defined contributions. So I guess in Hong Kong, I think their MPF is an example of where people have a responsibility to figure out their retirement income. So, applying LDI to those. So countries where that is, markets where that's needed is one. So I'd say there's many markets in different flavors depending on where you are. I guess it's not in Asia, but Australia, for example, has a huge DC market, and we had a lot of meetings with people from there as well, and they have less defined benefits. So depending on which market and what kind of, typically it's always in the retirement space, but as far as insurance companies as well, insurance companies more and more sophisticated needs for their investments on how to hedge their liabilities. And then we also see a growing need in that space as well.
Thank you. And I have one last question before we wrap up, I think. We might be able to take another one depending on how much time we have. But this one is specifically on, the retirement and decumulation funds, I believe. With improvements of medical services, people might be living longer. So is the cumulative period of about 20 years might be too short? Assuming that retirement age is 65, people might be living longer to age 90 to 95. What is the implication of that to the LDI strategy?
It's a very good question, and depending on different funds. So, for example, you have different periods. So you have one fund that would cover 0 to 20 years, but you would also have another fund that would cover maybe years 5 to 25. So depending on there was tools that were built to predict that depending on where you live exactly. So in Canada, we had built a tool that would say, oh, you live in Toronto in this part of the city, well, the expectation of life expectancy is X amount. So we'd have using big data to kind of predict that the best you can, and then build a set of portfolios. So it's not all set in stone in all 20 years. So you could have flexibility in the funds. You can have funds covering 5-year periods, and then you mix and match in order to cover your income needs during that. Kind of a personalization of your retirement.
Thank you. And I think we're almost up to time here, but maybe just one last question to wrap this up, and specifically noting today's environment. Do you see any changes in the LDI landscape given COVID and the current uncertain market conditions?
I think COVID obviously has brought down interest rates a lot, the growth prospects. So as far as people slowing down with LDI or not doing it, I'd say it's going to accelerate. That people are going to realize that right now income is more expensive to buy in the future.
Yeah.
So people are going to realize that they need more money, unfortunately, to retire for the standard living they thought they had 5 years ago. So I'd say, it's more of the impact on interest rate COVID has had on, global interest rate markets that have made it more expensive. So I'd say that's the driver from COVID.
Okay, well, thank you very much, Dick. I think we're about the end of our session, and thank you so much for your time, and thank you everyone for attending the session as well, and we hope that you find it informational. We would really appreciate it if you could provide some feedback for us on this session so it can help us improve on future events as well. Again, thank you very much for your time and have a great rest of your day.
Thank you very much.
Thank you.